Welcome back to Talk Tickers.
Hey, everyone.
If you are tuning in right now, you know exactly what this is. You are looking for the actual signal in the absolute, just deafening noise of earnings season.
Oh, yeah. It's a lot of noise out there right now.
It really is. And let me tell you, you have definitely come to the right place for this deep dive.
Yeah.
We are the premier earnings call summarization show for serious investors, the ones who want the gritty details without all that corporate fluff.
That's right. I mean, we listen to the calls, we parse the transcripts, and we just pull out the threads that actually matter for your portfolio so you don't have to sit there listening to an hour of awful hold music.
Exactly. And today is a massive one.
Huge.
Just to set the scene for you, it is February 2026.
Yeah.
And the semiconductor cycle is in this fascinating, almost weird spot right now.
Very weird.
Right. We're caught somewhere between this absolute AI euphoria, where literally everyone is still scrambling for a piece of the action, and this creeping, just nagging fear about capital intensity. Because everyone is looking at these balance sheets and asking, okay, how much does all this actually cost to build?
It is the classic tension of the hardware cycle. I mean, we've moved past that initial, that dream phase of 2023 and 2024.
Yeah, the hype phase.
Exactly. And now we are squarely in the build phase, and the build phase is messy, and more importantly, it is incredibly expensive.
It's so expensive.
Yeah.
And sitting right at that violent intersection of that euphoria and that expense is today's ticker. TSEM, Power Semiconductor.
Power.
Yep. Now, if you have followed this company for a while, or maybe if you just know them by reputation in the market, you probably think of them as this boring, steady specialty foundry.
Yeah.
You know, they make analog chips, they make sensors, they do their thing quietly in the background.
They have historically been the slow and steady player.
Right.
Tortoises in the race. They aren't out there chasing 2-nanometer logic chips like TSMC. They do high margin, specialized nodes. Very reliable, but rarely exciting.
We'll take that mental image and just throw it completely out the window.
Seriously.
Because Tower is trying to graduate. They're making this massive play to become the essential plumbing of the AI revolution.
Yeah.
And the setup for this earnings call we just listened to, I mean, it was basically a movie script.
It really was.
You have a massive earnings beat, you have a record quarter, and you have a partnership announcement with literally the biggest name in the world right now, NVIDIA.
On paper, I mean, if you just read the press release, it looks like the perfect quarter.
On paper, but the market.
Oh, man.
The market absolutely puked on it. We are talking about an open around, $144. A quick pop to a high of almost $147.
Yep.
And then just a nasty, brutal intraday reversal to close at $134. It was your classic pop and drop.
It was a violent reversal. And, when you see a company beat estimates, raise their guidance, drop the NVIDIA name, and they still sell off 7% from the highs.
It makes no sense on the surface.
No, it doesn't. You have to stop and ask, what did the smart money see that the headline readers completely missed?
And that right there is the thesis for today's deep dive. Why did the market sell off a double-digit beat? And the answer, I think we found it, lies in one single, terrifying word.
CapEx.
CapEx, capital expenditures.
It always comes down to the spending. Cash out the door versus cash coming in.
Exactly. So we are going to unpack the $920 million gamble that Tower's making, why they are betting the farm on silicon photonics, and why they think they have a winning hand even if the market is treating them like they're totally bluffing.
It's a high-stakes poker game, and the chips, no pun intended, are incredibly expensive manufacturing tools.
Ah, nice one. So let's get into it. Let's start with the snapshot. What actually happened in the numbers? Because if you just look at the P&L, this looked like an absolute blowout.
It really did. Let's break down the headline numbers first. So revenue came in at $440.2 million. That is an all-time record for them. It beat the estimates. That's up 14% year over year and up 11% quarter over quarter.
Okay, I want to pause on that for a second because 11% quarter over quarter growth. In the semiconductor world, especially for a specialty foundry that deals with things like industrial centers and power management,
right?
Double-digit sequential growth is incredibly strong. Usually these guys grind out 2 or 3% gains on a good quarter.
Yeah, exactly. It signals a real step change in demand, not just the standard cyclical upswing. And the bottom line was even better.
Let's hear it.
Non-GAAP EPS came in at 78 cents. The street was looking for 68 cents. So they beat by a full dime.
A dime beat. That's huge.
It is. That's a 15% beat on profitability. Net profit for the quarter was $80 million.
Okay, and usually when a stock drops after a beat like that, it's because the guidance was soft. You know the drill. It's like, great quarter, guys, but next quarter looks rough, so we are lowering the bar. But that wasn't the case here, was it?
No, not at all. The guidance was actually quite robust. For Q1 2026, they are guiding for $412 million in revenue, plus or minus 5%.
Okay.
If you do the math on that, that is roughly 15% year-over-year growth, and that was actually slightly ahead of the consensus estimates. So they beat the quarter, and they raised the outlook for the next one.
So the numbers literally scream growth stock. Revenue up, profit up, guidance up.
Yeah.
But the price actions screamed capital concern. I mean, we saw a huge volume spike, too. Over 5.6 million shares traded.
Massive.
That is a huge jump from the prior session. That tells me institutions were churning the stock hard.
Yeah, it indicates a complete turnover in the shareholder base. You probably had the momentum traders and the algos buying the headline, beat right at the open. You know, beat, raise, NVIDIA, buy.
Right, just scanning the keywords.
Exactly. And then you had the long-term capital allocators looking at the balance sheet and saying, whoa, wait a minute, look at the cash flow statement, and then selling right into that strength.
It is a psychological disconnect. And to understand it, we have to look at what is actually driving that growth.
Yeah.
Because Tower isn't growing because people are buying more toasters or old school cars.
No.
They are pivoting hard. Let's talk about the engine here, the AI infrastructure pivot.
This is the why behind everything happening at Tower right now. If you look at their segments, one stands out like a sore thumb. I mean, in a good way. RF infrastructure revenue was up 75% year over year.
75%.
Yeah.
That is hyper growth territory. That sounds like a cloud software startup, not a hardware foundry.
It is massive. And specifically, they broke out the numbers for silicon photonics, or SiPho, and silicon germanium, SIG. Combined, those two technologies brought in $421 million for the full year of 2025.
Which is what? A huge chunk of their total.
It's 27% of their total corporate revenue.
But the real stat, the one that honestly blew my mind when we were going through the transcript, was the breakout for SiPho alone.
Oh, yeah.
In 2024, silicon photonics revenue was $16 million.
Basically a rounding error.
Yeah. Literally a rounding error. In 2025, $228 million.
Incredible.
That is, I don't even know what the percentage is. It's basically going from zero to hero in 12 months.
It is an absolute explosion, and it validates the entire thesis that data centers are hitting a physical limit with copper wires. They need to move data with light. Right. That is what silicon photonics is. It's building lasers and optical detectors directly onto silicon chips to move data at the speed of light rather than the speed of electricity.
Okay, I want to unpack this tech for a second because I think this is where the value proposition really lives for the company. We throw around terms like silicon photonics a lot, but for you listening, if you aren't a chip engineer, what are we actually talking about? Like, why does AI desperately need this?
Okay, so think of a modern AI data center, like a massive sprawling city. The buildings in the city are the GPUs, the NVIDIA H100s or the Blackwell chips. These buildings are incredibly powerful factories doing calculations, but for the city to function, for the AI model to actually learn these buildings, need to send massive amounts of cargo back and forth to each other constantly.
And the roads between those buildings are the wires.
Exactly. Traditionally, those roads are made of copper. We send electrons down the wire. But as the GPUs get faster and faster, the traffic on those copper roads becomes an absolute nightmare.
Traffic jam.
Exactly. There is resistance, which creates heat. There is signal loss, which means data arrives corrupted. You physically cannot push electrons fast enough through the copper without melting the wire or losing the information. The whole city just grinds to a halt.
So the GPUs are just sitting there idle, waiting for the data to arrive.
Correct. And an idle GPU is a massive waste of money.
Yeah, especially at 30 grand a pop.
Exactly. So silicon photonics is like replacing those asphalt roads with magical vacuum tubes where the cargo travels at the speed of light. Instead of electrons, you are using photons. You are using light. Because light moves faster and generates almost no heat compared to electricity, you can move massive amounts of data instantly.
So Tower is essentially building the entry and exit ramps for these light tunnels.
Precisely. And this brings us to the elephant in the room, or rather the green giant in the room, NVIDIA. Management dropped the magic word.
They did. And we need to be really precise here because the market can get carried away with headlines. During the Q&A, an analyst specifically asked, are you shipping transceivers to NVIDIA?
Right.
And the CEO was very clear. He said no.
Right. They are not selling a finished box to NVIDIA. Tower is the manufacturing engine. They are making the chips, the silicon photonics integrated circuits, or PICs that go to the module makers.
Right.
Those module makers build the transceivers, and those transceivers go to NVIDIA.
So they are the Intel inside, or I guess in this case, the Tower inside, of the optical modules powering the big NVIDIA clusters.
Precisely. And the key stat they dropped is that Tower claims to be the majority supplier for 1.6 terabyte or 1.6 T silicon photonics chips.
Okay, let's unpack this for a second. 1.6 T, we hear these numbers thrown around all the time. 400G, 800G, 1.6 T. Why does 1.6 T matter so much right now in February 2026?
It is the new speed limit of the data center. When you have these massive AI clusters, think about the clusters training the really next-gen models. You have tens of thousands of GPUs that need to talk to each other constantly.
Right.
1.6T is the next generation speed required for these massive scale-out architectures. By saying they are the majority supplier for 1.6T, Tower is effectively saying we own the market for the fastest optical interconnects in the world right now.
That is a very bold claim. They aren't just saying we are a player. They are saying we are the majority.
Yes. The CEO used the phrase insatiable demand for compute bandwidth.
Insatiable.
Insatiable. He talked about scale-up and scale-out architectures. It really feels like they are positioning themselves not as a legacy chip maker anymore, but as a direct derivative play on the whole AI data center build-out.
That is the narrative shift right there. They want to be seen as an AI infrastructure play. They are the plumbing. You can't run the the data without the pipes, and they are looking investors in the eye and saying, we make the widest, fastest pipes.
Exactly. And if the demand is insatiable, the revenue potential is massive.
Okay, so that's the bull case. You have insatiable demand, you have the NVIDIA ecosystem connection, you have 1.6T dominance. It sounds absolutely amazing.
It does.
So why did the stock tank? Why did investors run for the hills at 10 a.m.?
Because building those pipes is incredibly painfully expensive.
Right.
This brings us to the CapEx controversy. This is the big risk.
The sticker shock.
Total sticker shock. Intraday, this is what killed the momentum dead in its tracks. Tower announced an additional $270 million in CapEx on top of what they had already planned.
So what is the total tab now? Let's give them the big number.
The total investment plan to expand the silicon photonics and SUGE capacity now stands at $920 million.
$920 million. Okay, let's put that in perspective for you. This is a company that just did $1.5 billion in revenue for the entire year, and they are spending almost $1 billion on equipment.
That is the ratio that scares conservative investors to death. When you spend 60 or 70% of your annual revenue on CapEx in a single year, you are just decimating your free cash flow.
Oh, yeah.
For the next 12 to 18 months, this company is going to be a cash-burning machine, not a cash-generating machine, at least in terms of free cash flow.
It is a bet the company moment. They are pushing all the chips into the middle of the table.
It is super aggressive. And in an environment where capital is still precious, the market gets very nervous.
Right.
They are out there thinking, well, what if the demand falls off? What if NVIDIA changes architecture? What if copper wires miraculously get better and they don't need optics yet? You just spent $1 billion on tools that you can't use.
Right. It's the fear of being left holding the bag, $1 billion bag of lasers. But management had a defense for this. And I thought this was arguably the most critical part of the entire call.
Oh, absolutely.
They didn't just say, hey, trust us. The demand is coming. They said, it's already sold.
Yes. This is the prepaid moat argument. Management stated explicitly that this isn't speculative building. They aren't doing the whole, if you build it, they will come routine.
Right.
They said over 70% of this new capacity is already reserved through 2028.
And not just reserved with a handshake or a nice little letter of intent. They mentioned firm commitments and prepayments.
That is a huge, huge distinction. Customers are putting down actual cash. That implies the scarcity is very real. If customers are willing to prepay a foundry to go buy tools, it means they are terrified they won't get the parts otherwise. It flips the whole leverage dynamic.
So the customers are basically funding the expansion, at least partially?
Correct. Which de-risks it significantly from a financial perspective. But there is still the execution risk. And this is where the bears really dig in. They are aiming for a massive increase in physical capacity.
Yeah, they said they want a 5x increase in capacity by Q4 2026 compared to Q4 2025. 5 times the output in 1 year.
That is a logistical nightmare to execute. Just think about what that entails. You have to get the tools delivered for the
Right,
manufacturers.
the applied materials and ASMLs of the world.
Exactly. Then you have to physically install them in the clean room. Then you have to calibrate them. Then you have to qualify them, meaning you run test chips, send them to the customer, and the customer has to test them and say, yes, this works perfectly.
And they are targeting that qualification by late 2026.
Right. And late 2026 is a very long time in the stock market.
Hmm.
That is basically a full year of dead money where they are spending cash hand over fist, but not seeing the full revenue benefit yet.
It creates an air pocket in the stock.
Exactly. That is the market friction we saw. The market hates a story that says, give us your money now, we will spend it all this year, and the growth will really kick in 2027 and 2028.
Investors are notoriously impatient.
Very. They created a prove-it discount. The sell-off was effectively the market saying, okay, we believe the demand is there, but we don't know if you can actually get $920 million worth of incredibly complex optical manufacturing tools up and running in 12 months without a hitch.
It's the show me state.
It is.
Yeah.
And if they miss that deadline, like if they slip from December 2026 to June 2027, that stock is going to get punished even harder.
So we have this really tight tension. Insatiable demand versus terrifying spending. But they tried to sweeten the pot. Right?
Yeah.
They tried to show us the end of the rainbow. They released a brand new financial model targeted for 2028.
The bold growth targets. This was their attempt to show what the company looks like after the spending spree is finally over.
And the numbers are pretty eye-popping if they can actually hit them.
They are. They're targeting $2.84 billion in revenue for 2028. That's nearly doubling the current revenue. But the real story is the margins. They're targeting a 40% gross margin and an operating margin of 32%.
Okay, 40% gross margin for a specialty foundry is elite. That puts them in a very exclusive club.
It is absolute top tier. And it results in a net profit target of $750 million. That is a 26% net margin.
So if they hit this, they are basically tripling their net profit compared to what they just reported for 2025.
Yes. And that is the carrot they are dangling in front of Wall Street. They are saying, endure the pain of the CapEx in 2026, and in 2028, you will own a company printing $750 million in pure profit.
But how are they getting margins that high? Is it just volume, scaling up the fabs, or is it pricing power?
It is the mix shift. This is a crucial part of the strategy to understand. They are explicitly shedding lower margin business.
Okay.
They mentioned that discrete and mixed signal revenues were down significantly. They're essentially kicking out the low value products to make room in the fabs for this high value optical work.
Right, because fab space is finite.
Exactly. Silicon photonics commands a massive premium. It is incredibly hard to do. Not everyone can make it. So they have pricing power there that they just don't have in standard power management chips.
It is addition by subtraction. Get rid of the commodity stuff, fill the fab with the high margin AI stuff.
Exactly. But that transition period is bumpy. That is why you see some segments down while others are rocketing up. It's like you are evicting the low-paying tenants to renovate the apartment building for luxury condos.
That's a great analogy. And speaking of segments that are down, we have to talk about the other business, because it wasn't all sunshine and lasers on this call. The mobile business took a real hit.
It did. RF mobile revenue was down 15% year over year.
That is a significant drag. What is happening there? Is the smartphone market just dying?
Not dying, but evolving. There were two factors here. One, again, is that strategic setting we just talked about. They're actively moving away from lower margin controllers. But the second factor was really interesting. It was a supply chain warning. Management hinted at memory shortages impacting actual handset volumes.
Oh, that is fascinating. So the phone makers can't get enough memory chips.
Right. If Apple or Samsung can't get the DRAM or the NAND flash they need to build the phone, they don't build the phone.
Makes sense.
And if they don't build the phone, they don't need Tower's RF front-end chips. It is a classic ripple effect. Tower is sitting there ready to ship, but the phone isn't being built because a totally different part is missing from the assembly line.
That is the wild complexity of the semiconductor supply chain. You can be executing perfectly, but if the guy next to you trips, you both fall down.
Precisely. And then there is the other big piece of news that has been hanging over this stock for a while, the Intel divorce.
Oh man, the Intel Fab 11X saga. For you guys who haven't followed this soap opera, Tower was originally supposed to merge with Intel a couple of years ago.
Right.
That failed. Then they made a deal to use Intel's Fab 11X in New Mexico to expand capacity. And now that is dead too.
It is officially dead. They confirmed on the call that Intel pulled the plug on the agreement from September 2023. They are currently in mediation.
So what does that actually mean for their capacity? I thought they needed that fab to grow. I mean, the bear case was always, oh, Tower's running out of physical room to build.
That was definitely the fear. But management was very clever in how they framed the new 2028 model. They explicitly stated that the $2.84 billion revenue target does not include Intel Fab 11X at all.
Ah, so they are saying we don't even need them.
Exactly. They are redirecting those customers to their own Fab 7 down in Japan. They are telling the market, look, this growth is organic. It is entirely Tower-owned capacity. We are not reliant on a partner who might just suddenly change their mind.
Right.
It cleans up the story so much, it removes the whole Intel overhang risk, even though it reduces their theoretical maximum capacity in the U.S.
Honestly, it is probably for the best. Relying on Intel right now seems, just given their own internal struggles, it seems risky.
The market usually prefers certainty over potential. Knowing that Tower controls its own destiny with this new CapEx plan is cleaner, even if it is more expensive for Tower directly. They are driving the bus now. They aren't just sitting in the passenger seat hoping Intel gets them there.
All right, before we get to the final verdict, we have to talk about the tone of the earnings call itself.
Oh, boy.
Because usually these things are so dry. You know, revenue is X, tax rate was Y, thanks for your questions. But Russell Ellwanger, the CEO, he went somewhere else completely at the end of this call.
He really did. It was his 20th anniversary as CEO, and he delivered what I can only describe as a philosophical treatise.
It was a full monologue. He started talking about his epitaph.
Yes. Bold growth, limitless impact, infinite reach. That was the central theme of his sign-off. He quoted David Deutsch from the book The Beginning of Infinity. He quoted Bill Clinton.
And he fixed the Bill Clinton quote.
He did. He said Clinton talked about memories outweighing dreams, but Russell actually added action to the quote to make it fit his point. He compared the company to a Da Vinci masterpiece.
I have to ask you, just as an investor, when you hear a CEO start talking about virtue and love and masterpieces on a Wall Street earnings call, does that make you want to buy or sell?
It is incredibly polarizing. The algorithmic traders reading the transcript probably just short-circuited.
Oh, for sure.
They are scanning the text, looking for guidance rays, and they get infinite reach.
The AI trading bot is sitting there like, does infinite reach impact EPS by 3 cents?
Exactly. But if you look at his actual tenure, 20 years, he took this company from nearly bankrupt 2 decades ago to a global leader in silicon photonics today. I think you have to give him the benefit of the doubt here.
Yeah, that's fair.
It signals a visionary leader who is focused on a decade-long legacy, not just the next quarter's EPS beat.
It definitely shows he isn't just a bean counter. He truly believes they are building something historically important.
But it also might explain why he is so willing to spend $920 million right when the market is skittish. He sees the infinite reach of the technology while the market just looks at the depreciation schedule. He is playing a much longer game than the day traders.
Okay, so let's bring it all together for the listener. The verdict. We have the bull case and the bear case.
Yep. Let's do the bull case first. It is pretty clear you are buying the picks and shovels for the massive AI networking upgrade.
Right.
1.6T is coming, Tower has the chips to make it happen, and 70% of their new capacity is already sold and paid for. Plus, the valuation is significantly lower than the high-flying logic chip names. You aren't paying 50 times earnings here. You are buying a company that is potentially about to triple its profits in 3 years.
And the bear case.
CapEx intensity is skyrocketing. You are burning massive amounts of cash right now, and the execution risk is extremely high.
Yeah, the timeline.
Installing nearly $1 billion of complex tools in 12 months is really hard work. If they stumble, the stock gets absolutely crushed. Plus, mobile is weak, and the Intel safety net is gone.
And the market signal. That violent sell the news reaction we saw at the open.
It tells me the stock is in the penalty box for now. Investors are saying, we hear the story, but we don't believe you can do this on time. It is a wait-and-see stock until we get closer to late 2026, and we actually see those tools turning on and shipping wafers.
So if you are trading this, you watch that $134 level. If it holds there, maybe the CapEx fear is finally priced in.
Exactly.
All right, that brings us to our absolute favorite segment of the show. The part where we throw all caution to the wind and pitch a trade that is absolutely reckless, probably dangerous, but just might work.
Please remember, everyone listening, what we are about to say is for entertainment purposes only.
Totally.
We are idiots with microphones. Do not trade on this. This is not financial advice.
But if you were a hedge fund analyst pitching to your investment committee today, here is the trade. We call this one the photon trap. Or actually, you know what? Let's call it the speed of light spread.
I like the speed of light spread. So what is the structure?
Okay, here is the logic. The market is terrified of the $920 million spend. They think Tower is going to miss the December 2026 deadline. But we know the demand from NVIDIA and the others is insatiable. So this is a long-dated volatility play.
Go on.
Leg one, you buy the January 2027 calls.
Okay.
You go deep out of the money. You are betting that by late 2026, they announced the tools are qualified, the 1.6T ramp is real, and the stock doubles to start pricing in that massive 2028 financial model. You are effectively buying the optionality on them hitting the deadline perfectly.
Okay, so you are leveraging the upside of the execution. But options are expensive, especially with high volatility around a semiconductor name. How do you fund it?
This is the spike part of the trade. You fund those calls by selling puts on Intel.
Oh, that is nasty.
Hear me out. We are betting that Tower's organic growth in silicon photonics vastly outperforms Intel's current foundry struggles. We are effectively betting that a niche Israeli foundry becomes more critical to the AI supply chain than the former U.S. chip giant, solely because they figured out how to make light move faster than electricity.
So if Intel stays flat or goes up slightly, you keep the premium from those puts and use it to fund the Tower moonshot.
Exactly. And if Intel crashes, well, then you get assigned and you own Intel,
Yeah.
which is kind of a punishment in itself right now.
That is truly outrageous. And yet, given the CFO numbers we just went through, there is a certain twisted logic to it. You are shorting the past to go long the future.
It is the speed of light spread. You heard it here first.
Again, do not do this.
Definitely don't do this, but definitely keep watching Tower Semiconductor. This is a fascinating quarter to dive into. Great numbers, incredibly scary spending. The bet is entirely on the speed of light.
And whether they can actually build the machine to harness it in time.
Keep an eye on that $130, $40 level. We will see you all next earnings season for another deep dive.
Talk tickers out.